Hello and welcome to the Business Standard Morning Show. I'm Swapnil Jogleka. Let's take a look at the stories for the day. The government has approved the Indian Space Policy 2023 that seeks to institutionalize the private sector participation in the space sector. With a stable policy in place, more private players are expected to enter this huge market, whose global value is pegged at $447 billion. So, what does the road ahead look like? Watch Debar Gasanal's report to know the answer.
India is emerging as a force to reckon with, not just on the ground but in space too. Several global private space companies are now turning towards the country as an alternative to China and Russia due to Beijing's increasing tension with the US and Ukraine attack. The two countries, along with SpaceX, have been the main providers of satellite launches. London-based OneWeb too turned to India recently after Russia scuppered the original launch last year. And last month, India's state-owned New Space launched 36 communication satellites for OneWeb from an island off the nation's eastern coast. Only a few days later, India came out with a space policy. Last Thursday, the Union Cabinet approved the much-awaited Indian Space Policy 2023. After the announcement, Union Minister Jitendra Singh said that private sector companies will now be able to build rockets, satellites, and launch vehicles, and therefore gain access to end-to-end space activities. This new space policy, which was approved by a cabinet committee hemmed by Prime Minister Narendra Modi, clearly defines the responsibilities of ISRO, the space sector PSU New Space India Limited or NSIL, and the Indian National Space Promotion and Authorization Centre or INSpace. It is also designed to regulate and boost private sector participation and investment in the space sector.
The role of ISRO would be more of development of new technologies, validation, testing, certification, the role that a typical space agency should be doing. Whereas the policy would also encourage the private sector to from being vendors to ISRO to being partners, and in the larger scheme of things, to become full-time players in the space industry, not only in terms of launches, but also in development of satellites, communication, navigation, surveillance, observation satellites. The third aspect of this policy would probably be the institutionalization of in-space as an interface between the industry, stakeholders, and ISRO.
Currently, despite leading in complex space tech and launch vehicles, the Indian space market is worth $7 billion US, which is just about 2% of the global space market. So, what are the opportunities that the policy offers, and are there any challenges that should be addressed?
The biggest challenge is that the industry generally in the space sector has always remained a tierized, as I said. So there has always been a dependence for knowledge on the ISRO. To stand on their own feet, they will have to find enormous amount of business models, which gradually elevates them from the tierized to the main players. Also, handholding by the government agencies is going to be essential and required. And this is precisely where the role of the in-space. The third aspect is to ensure that the policy grants a perfect level playing field, because handling material that are perfectly stable in space in the perfect vacuum is something very, very special. We are all conscious that this is something which has to be granted and allowed to the smaller players.
The strength of the Indian space program lies in its frugal engineering. The cost of launch of satellites by India is much lower as compared to its counterparts in the West. Uh, I can see that being taken over by the private sector as well when they are developing new technologies, even in the cryogenic sector, as well as in development of the buses for the satellites and the applications. The future of space in constellations and small satellites. I think most of the private sector players would target that.
And what are the areas that need immediate attention?
Very particular in peculiar in case of space, the 80% of space market actually is in getting data and analysis of that data and proliferating that data in different forms. Data access and availability of data today, especially in case of India, is only with the different departments of the Department of Space. Now, this is where access to the data becomes extremely important. Now, on the second side is after the data is available, what is the cost that data is available at? How does it compare with the international prices if from somewhere else it has to be taken?
While experts welcome the policy's initiative to boost private participation in the space sector, they also point out that this should be taken as an opportunity to upscale India's space exploration infrastructure.
The government recently notified another set of rules, this time for the online gaming industry. It was long awaited. The new rules prohibit betting in online gaming while opting for a self regulatory model for games involving real money. But how effective will these rules be? And will it add red tape to the Indian online gaming industry? Tushar Verma brings the answers.
The government has notified a new set of rules to regulate the online gaming industry, which prohibits wagering games involving real money. These rules, which come as an amendment to the IT Rules 2021, largely leave the industry to self-regulate and emphasized on designing non-addictive games, protecting child rights, preventing financial fraud, and safeguarding the country's integrity. A key aspect of the revised rules is regulation through new self-regulatory bodies that the IT Ministry will approve. These SROs will constitute experts from various fields such as education, psychology, protection of child rights, and industry experts and representatives. But will the new gaming rules and the self-regulation model act as red tape and curb the growing industry, or are they steps in the right direction?
So while a lot of people in the industry have hailed these rules and praised the government, but I think it does, hold out that this is going to create more red tapeism, especially the fact that there are going to be three SROs with the provision for the government to create more SROs. So the self-regulatory organizations would then have members appointed by the government. Then there are specific criteria with regard to. So it's like another tool for the government to oblige people.
Well, I think it is an excellent step. It won't add any bureaucracy. Quite to the contrary, it is going to ease things for the industry. This step has been fast, it is decisive, it is industry friendly, it is pro-consumer, it is going to increase and help in innovation in this industry. So no red tape at all. It is exactly what the industry had been lobbying for and asking for all these while.
For the time being, 3 SROs will be formed, which can later be increased as per the industry requirements. The question here is, what is the need of 3 SROs? This is pertinent since self-regulatory bodies of some other industries have not been successful in implementing the desired guidelines.
If you look at the size of the the gaming stakeholders, they are in the excess of 850 online gaming companies. Now, it is not practical for one SRB to manage such a large stakeholder base. Point number 2 is innovation. Now, what happens is if you have one SRB, there is a possibility that the larger the older formats or the larger companies would like to block innovation. So it is important to have more than one.
The online gaming industry is relatively new in India but has been gaining strong momentum with a compounded annual growth rate of 38%. It is no surprise that the industry is expected to be worth around 380 billion rupees by 2026, according to the National Investment Promotion and Facilitation Agency. So, what are the regulatory challenges facing this relatively new sector?
So it will be crucial to ensure that the SROs operate fairly and do not curb the innovation and the startup ecosystem. So there is a 300 million customer of India which subscribes to online gaming industry. How do we grow the industry and not curb the industry is going to be one of the crucial steps. It is necessary that the SROs have a swift approval process so that the new startups do not end up losing competitive advantage and the ease of doing business is maintained in India. A uniform code of conduct will help in speedy approvals and will also ensure a level playing field for the online gaming industries in India.
The industry has experience of getting into tussles with the union and state governments in the past. While the new rules have prohibited all real money online games which involve betting or wagering, the constitution has put gambling laws on the concurrent list. This means state governments can also frame laws in the matter. Days after the notification of new rules, the Tamil Nadu government passed a bill banning all online games that involve real money. This effectively outlaws even skill-based real money online games. Does this reflect the prospects of a center-state tussle in the industry? And will the distinction between chance-based and skill-based games remain muddled even after the Supreme Court's clarification?
As per the Indian laws, the online gaming industry, which is skill-based gaming, is regulated by the central government, right? Whereas gambling can be regulated by the state government. So a blanket ban basically is something which is against the rule of the country. So something like this, I think, will be challenged in the court and will not have larger standing. The exact reason for Government of India to come out with these online gaming laws was to ensure that such blanket bans are not put across states.
While the gaming industry at large has welcomed the new rules, some experts believe that too many SROs will only create more red tape. In matters of uniformity of law when it comes to regulations, experts are of the opinion that the laws should be industry friendly. And how exactly the fresh set of regulations will pan out remains to be seen.
Sticky inflation, firm crude oil prices, and the likelihood of a subpar monsoon back home are unnerving the markets. So, should investors choose to play it safe and stick to the large caps? Puneet Wadhwa spoke with analysts on what they think is the ideal investment strategy. Let's take a look.
Sticky inflation, rate hike cycle by global central banks, firming up of crude oil prices and a possibility of subpar monsoon back home are likely to keep overall market mood in check over the next few months. Against this backdrop, analysts feel investors will be better off staying with the large cap stocks. Rahul Arora of Nirmal Bang expects the large caps to outperform their mid and small cap peers as investors seek safety of returns. Our bias will be towards large caps since we expect 2023 to be one of risk aversion in the aftermath of the impending effect on the global economy due to incessant rate tightening by central banks. On a relative basis, large caps will outperform the mid caps this year. In the 2022-23 fiscal year, the small cap index underperformed the large cap index on the BSE by a wide margin. While the S&P BSE Sensex ended FY23 with a gain of 0.7%, the small cap mid cap indices on the BSE and BSE 500 indices lost ground. Investment wise too, analysts suggest investors accumulate large caps after the recent corrections as valuations have become attractive. Market valuation has become quite attractive. The Nifty's 1-year forward price to earnings or PE is down to 17.3x, which is a 10-year average. However, given the multiple headwinds, we continue to suggest a tilt towards top 250 stocks in terms of market cap ranking till the overall market sentiment improves. Devarshi Vakil, deputy head of research at HDFC Securities, suggests large cap companies typically have better cash management systems that make their business more sustainable. However, it does not mean that stocks of these companies cannot undergo a correction and should be considered a safe haven bet, he said.
If we study the history of Nifty for the last 2 decades, we find that there are more than 100 changes in its constituents. There were some then considered large and established companies who are now nowhere to be seen. Apart from that, there are enough and many examples of large cap and index stocks having a bad couple of years where the stock price is halves. So we do not think that any stock should be considered a risky because of its market capitalization is relatively lower compared to large companies. Any company whose earnings are endangered due to disruption in business model, or company has an unsustainable debt on balance sheet, promoters are highly leveraged, or company has related party transaction or debtors which are questionable on the books, that should be considered a risky company.
So, while sticking to large cap stocks seems to be a better option for now, investors must take a hard look at the company's financials before investing their hard-earned money. With the Q4 FY23 results kicking off this week, stock-specific action is likely to continue. Domestic and global cues too will impact sentiment.
Several startups have put fundraising from the primary market on hold due to prevailing uncertainty. Some of them have taken different routes to raise capital. Convertible Notes is one of them. App-based instant grocery delivery startup Dunzo recently secured funding of $75 million through it. But what is a convertible note? Tushar Verma brings it down for you.
A convertible note is a financial instrument that allows a company, usually early stage startups, to raise capital through debt which can be converted into equity. Startups prefer convertible notes because they are a faster and more cost-effective way of raising funds. The process involves less paperwork and avoids the complexities of determining the startup's valuation. Valuation is an important aspect of fundraising that can lead to conflicts between investors and startups. Convertible notes help both parties save time and money by postponing the valuation process. Unlike equity financing, no amount of ownership is transferred to the investor with convertible notes. Therefore, the founders of the startup retain full control of the company's decision-making process. At an agreed point of time in the future, convertible notes accrue interest and convert to equity. The notes also carry a discount on valuation during the subsequent round of funding. This ensures that the investor benefits from the startup's success. However, there are chances that the startup performs exceedingly well and becomes highly valued. At very high valuation, even after the set discount in convertible note, the ownership of the initial investor may get diluted. To prevent this, convertible notes carry a valuation cap. This limits the maximum valuation at which the startup can be valued. Convertible notes are gaining popularity due to their ease of arrangement. Apart from the recent example of Dunzo, B&B firm Udaan reportedly raised $200 million through convertible notes in January 2022. However, convertible notes can lead to trouble if the startup fails to perform or goes bankrupt.
I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Experts believe that convertible notes don't delay the down rounds but provide struggling startups a chance to improve their metrics. That's all for today. Catch the next episode of The Morning Show tomorrow. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.